Michael Pond, if I look at the real yield and I look at two partial differentials of the nominal yield and some measurement of inflation, which matters right now?
It's the real yield that matters, and it's moved up a lot over the summer. The market was not really buying into the Fed's resolve to hike rates enough to slow the economy, getting inflation down. Since Jackson Hole, though, real yields have soared, particularly at the front end, where they were almost at zero earlier this month. Now they're above 1% when we look at short end forward. So the market's moved a lot and really accepted the hawkish tone of the Fed.
So if I look not at the 10-year real yield, but Michael Pond, let's go shorter to maybe the 2-year, if you agree with me on that, from a negative 300 basis points inversion to a positive 164 basis points. That's a hugely linear jump condition. How do other asset classes react to the Michael Pond world?
Well, risk assets do not love higher yields that are not supported by strong growth. Really, where real yields are rising here is because the Fed has become much more hawkish, trying to slow the economy. And that's in part why risk assets have been on the back foot since Jackson Hole. So the Fed's trying to get the economy in a position where inflation comes down, and then it can take its foot off the brake a little bit and allow growth to go back up. But we think we're years from that. The Fed's resolve is strong here. That was clear at the Jackson Hole speech by Chair Powell, ripping up the script then and channeling his inner Volcker. Risk assets have responded, but now they're at the point where perhaps they've overreacted. You know, obviously we'll get a message from the Fed that's on the hawkish side, but markets are already prepared for a very hawkish Fed. So it's a delicate balance today.